When you crack open a financial report, you're hit with this wall of numbers. But what do they actually mean? Today, we're going to move way beyond just simple calculation. We're going to uncover the economic story that's hiding in plain sight, using the techniques that separate basic accounting from true financial analysis. So let's just tackle this head on. Is financial analysis just a math exercise? Is it all about plugging numbers into formulas and calling it a day? Well, let me tell you, the answer is a huge no. And really getting that difference is what this is all about. And this right here, this gets to the absolute heart of it. Computation just tells you what the number is. It's simple. But analysis is the real detective work. It's where you ask why the number is what it is. And, maybe most importantly, what does this mean for the company's future? All right, so here's our game plan for today. Think of it as our investigative roadmap. First, we're going to lay down the essential framework every analyst needs. Then, we'll open up the forensic toolkit. We're talking ratios and common-size statements. After that, we'll see how to track changes over time. And finally, we'll put all those clues together to build a really powerful insight. First up, the analyst's framework. And this is so important. Any really solid analysis doesn't start with a calculator. It starts with a structured plan of attack. This is your 6-step investigation plan. This framework is your guide through the wilderness of data. And look, it all starts with step 1, articulating your purpose. What are you trying to do? Are you deciding whether to give a company a loan, or are you trying to figure out if you should buy its stock? That purpose is your North Star. From there, you collect, process, and analyze the data. But look at those final steps. They're crucial. You have to communicate your conclusions and then follow up. This whole process is what turns a giant sea of data into a clear, actionable story. Okay, so we've got our framework. Now it's time to open the forensic toolkit. And the two most powerful tools we have for interrogating a company's financials are ratio analysis and common-size statements. So what is ratio analysis really? It's all about creating context. By taking one number and relating it to another, say net income to revenue, we create a standardized metric. This is huge because it gets rid of the distorting effect of size. It lets us make a real apples-to-apples comparison between a massive corporation and a tiny competitor, or even just track one company's performance over the years. Now, this is a really, really important mindset to have. A ratio isn't the destination. It's a signpost. It points you in the right direction. It tells you where to look and what questions you need to start asking. So if a company's profit margin is sky high, the ratio tells you that, but it's your job as the analyst to dig in and find out why. You can basically group ratios into 5 key areas of investigation. Activity ratios ask, hey, how efficiently is this company actually using its assets? Liquidity and solvency ratios are all about risk. Can the company pay its bills, both short-term and long-term? And then profitability and valuation ratios. They get right to the bottom line of performance and what the market thinks about the company. Okay, quick technical timeout, but this is one of those rules you absolutely have to get right. Remember, an income statement is like a movie. It measures performance over a period of time. A balance sheet, on the other hand, is just a snapshot, a single picture in time. So if you're making a ratio that pulls from both, like return on assets, you must use the average of the balance sheet number. That's the only way to fairly compare a full year of income to the asset base that helped generate it. All right, let's talk about our next powerhouse tool, common size analysis. This technique is just fantastic for peeling back the layers and seeing the internal structure of a company. By turning every single item into a percentage of a base, like total assets, we get to see the company's financial blueprint. You know, what it's made of, and how all the pieces fit together. Just look at this. The difference between these two companies just jumps right off the page, doesn't it? Company 1 is sitting on a mountain of cash, 38% of its assets. So you have to ask, why? Are they about to buy someone? Meanwhile, look at Company 2. A massive 55% of its assets are tied up in receivables. That immediately makes you wonder, are their credit policies way too loose? So here's the magic of it, right? Common size analysis is the great equalizer. It lets you compare the fundamental financial DNA of two totally different companies, no matter their size. Suddenly, you're not just comparing dollars, you're comparing their core strategy and structure. But, a single picture, a single snapshot, is never the whole story. A company's real story? Well, that unfolds over time. And that brings us to our third section, how to track performance and structural shifts, both against a company's own history and against its rivals. So you've got two fundamental ways to compare things. Cross-sectional analysis is about looking sideways. How does our company stack up against the competition right now? Trend analysis, on the other hand, is about looking backward. How has our company's performance changed over the last, say, 5 years? You absolutely need both perspectives. And here's that trend analysis in action. By setting everything to a base here, whoa, the dramatic shifts just pop. Look at this. In 5 years, cash has fallen off a cliff, down by almost 60%, while receivables have soared by 80%. This isn't just a small change, this is a massive, fundamental shift in how this company is managing its business. And this is a perfect example of that cross-sectional view. In just one glance with one simple chart, we can see that Company A's gross margin isn't just better than its direct competitor, Company B, it's also crushing the industry average. That gives you immediate context for its performance. But a single bar chart or a quick 2-point comparison only tells you part of the story. To really get the dynamics, you need to see the whole movie, not just one single photograph. And for that, we turn to the power of graphs. So why bother with graphs? Seriously, why? Because they are absolute game changers for storytelling. They turn these dense, boring columns of numbers into an intuitive story. A simple line graph can instantly show you if margins are eroding over time. They make trends and risks pop right off the page, and they're one of your best tools for communicating your findings. And this brings us to our final and honestly our most important section. We've used our framework, we've used our tools, we've gathered all the clues. Now it's time to assemble them into a single, powerful insight. I cannot stress this enough. Nobody cares about a list of 50 ratios. That's not the goal. The entire point of this is to build a cohesive story, a narrative that explains what's going on with the company's performance and its risks, all to support a real-world decision. Are you going to invest? Are you going to grant that loan? Your analysis has to lead to an answer. It all comes down to this. All the different techniques we've talked about, the ratios, the common size statements, the trend analysis, they aren't separate things. They are all just threads that you have to weave together into one coherent story that explains the economic reality of the business. And that, right there, that's the whole ballgame. This is what we do. We use these structured techniques to transform the black and white numbers you see in a report into a full color understanding of a company's health and its future. It's about turning data into actual economic insight. So I'll leave you with this. The next time you open an annual report, don't just see the numbers. See the clues. Ask why. What economic story are you going to uncover?